And we'll get it going. I'll keep my boardroom intro brief as usual, and we will kick everything off here with the Moonwell minute. Essentially just a quick portion of the Gov call, looking at a couple of governance metrics from the past month. First up is proposal participation, which, like last month, this is really the most interesting thing I think to look at. We're still getting upwards of, let's see here, 173 kind of on the low end, going up to 254, 313, all the way up to a peak of 351 votes this month. Again, these are still very high compared to other protocols. So yeah, it's pretty encouraging to still see this elevated voter turnout. And the second thing I wanted to bring up was the delegate participation here. So a minor change, but I think it's still interesting to note. Basically, what we've seen this past month is a slight change in the makeup of the top 1,000 delegates here, on the order of just a few percentage points. Basically, both the active and the inactive delegate numbers have dropped by a little bit. The active delegates by about 0.5%, and the inactive by about 1.5%. And of course, that means that there was an equivalent increase in the number of ghost delegates by about 2%. So basically, this means that if they're a ghost, that means that they've never voted on any proposal. Inactive being that they voted once, but not on the last three proposals. In simpler terms, basically that means we're getting new top 1,000 delegates who have never voted on a proposal, which can be explained by the growth on both base and optimism. As new users are coming in, it may take some time for them to get familiarized with how governance works and to cast their first vote. Is essentially it for the Moonwell minute.
Do you mind if I jump in and just say a couple words really quick before we get started?
I was about to do that. Yep, go ahead.
Thank you. First of all, I just want to thank everyone in the Moonwell community, especially those of you on the call here. Anyone joining the governance call, you are most active and participating in our community the most, and really appreciate you. I just wanted to kind of wish you all a happy holidays, as we've recently achieved a great amount of success on base and optimism, and we crossed $1 billion total market size on base. Really exciting to see that happen, and you all are a big part of that, and so thank you very much. And then I just wanted to give a quick comment on the recent changes to the voting requirement for our safety module. So if you guys remember, we ratified through a snapshot vote once every 30 days requirement to claim your rewards on the safety module. That has actually really helped governance participation a lot, and maybe, Alex, that's why you're seeing some of the increase in numbers of people voting. Prior to that voting every 30 days requirement, we were sometimes struggling to achieve quorum, which is 100 million votes. But since then, most of the votes have been getting 3x quorum. I've been looking, they've been getting 200 to 300 million plus votes per proposal. And so that's really kind of showing us in the metrics and the numbers that requirement is working and helping out. And I know that that's kind of a pain sometimes to if you don't remember to vote or if you're away for a while. But just remember, you can always claim your rewards later. And we've tried to remind you in the front end when there is a proposal up, if you haven't voted in the last 30 days, just so that you can kind of like go right to the Gov page. And if you're concerned about like you don't want to vote yay or nay, just vote abstain. That counts too. If you don't want to express an opinion for or against something. But I just wanted to thank everyone for kind of being a part of the community. Wish you a happy holidays, and thank you for your support. It means a lot to all of us that are contributors in the ecosystem. Thanks.
Yep, thank you, Luke. And before I get into the main agenda, Darren, if you want to give your spiel.
Yeah, so everyone, I recently uploaded a proposal to list Well into the core markets. I think that's a proper time to list it, given that it recently got a Chainlink feed on base, and also that liquidity for Well is at an all-time high. So if everyone could just give that a review, I would really appreciate it. But if you have any thoughts on it, let me know.
Okay. Yeah, for the main agenda of the call, I think that Chainlink is here in the audience as well. So if you want to basically pitch in at any point in this conversation, go ahead and feel free to do so. Yeah, the main theme for the call today is going to be the great OEV debate, because in the past few weeks we saw basically in quick succession multiple teams coming forward with proposals on the forums for their different OEV solutions. And so, yeah, the main point of the call today is just to give everyone a quick chance to make their pitch to the community and to eventually solicit feedback from everybody. So as a quick explain like I'm Vive for OEV, Um, it's essentially similar to MEV, but it specifically relates to oracles and the value that can be extracted from the usage of them. So yeah, but I guess without going any deeper than that, I'll delegate that to the domain experts that are on the call today.
Alex, do you want me to jump in here? Yeah, let me just give a quick explainer before we kick off of what OEV is, because it's a very complex term and maybe not everyone in the audience understands it. But basically, what happens when there is a loan that is underwater on Moonwell? Like, somebody has not enough borrowing power for what they borrowed. Maybe their collateral went down in price. What happens is liquidator bots typically try to liquidate that underwater position, and basically what they can do is repay up to half of the loan, and then they get to, in exchange for repaying it, they get some of that borrower's collateral. They can seize that collateral plus a bonus of 7%. And then they can usually sell that collateral on a DEX like Aerodrome or Uniswap, and then they kind of keep the profit, whatever, the bonus of 7% minus whatever slippage on the DEX. So that's a really normal market function, and it keeps our markets healthy, because if you don't liquidate underwater loans, then the entire protocol incurs bad debt. So it's very important for those liquidations to happen quickly and efficiently. Now, the 7% is actually a really large bonus. If you look back historically, on August 4th, there was a big market dump, right, where I think Ethereum dropped below $2,000, Bitcoin dropped a lot. It was a really bad day for markets. And on that day, there was $3.6 million in liquidations on Moonwell alone. And so if you think about it, the liquidators actually earned 7% of that $3.6 million. Quite a profitable trading strategy for these bots, right? Now, on mainnet Ethereum, you see these MEV relays like Flashbots and Fastlane and others, and they actually have like an off-chain auction for the right to basically get your transaction, your bot liquidation transaction, at the top of block, meaning you get to liquidate first before others. And typically on mainnet, we see those that off-chain auction sometimes bids as more than 99% of the liquidation value. And so, these liquidator bots are really efficient at liquidating very fast. And so OEV basically, or Oracle Extracted Value, basically gives the liquidators the right to post a price early before someone else, and liquidate an underwater loan before someone else. And so that's basically kind of how it works. And if it's done properly, it can actually make the markets even more efficient, because it means prices get posted earlier to the price feed, meaning liquidations happen faster, which means less risk to the Moonwell protocol, more efficient liquidations, and that profit from the liquidation from the off-chain auction or the on-chain auction, in the case of one of these solutions, can actually be shared with the protocol, meaning more protocol revenue for Moonwell. So if we can implement OEV in a safe way, then it should be a win for everyone. It'll be more efficient markets, faster liquidations, and more revenue for Moonwell, the protocol. So I just wanted to give that context, and really excited to kind of hear from all the teams that are competing for the right to, or the opportunity to basically test OEV solutions on the Moonwell protocol. And let's start the discussion, I guess.
Perfect. Yeah, thank you for that context. That was much more beautifully said than I could have done. For the order of the speakers, we'll just go alphabetical. So Dave with API 3, if you want to kick it off.
Hi, everyone. Thanks. Thank you for the context, Luke. I both appreciate it, and you've taken half the stuff I was going to say, and you've already mentioned it to everyone. But it's great. It's a nice explanation of OEV. So what I'd like to focus on is how API 3 intends to do OEV, the proposal we have up on the Moonwell governance forums at the moment, and what would differentiate us from the others, and why we think API 3 and Moonwell would be a very good fit. So first of all, the way API 3's OEV works is focused on allowing these people who would trigger liquidations on Moonwell the ability to trigger extra data feed updates, which is a key differentiator from some of the other solutions. So practically in the real world, say the price of Ethereum is $3,501. If it goes down to $3,500, a big liquidation becomes available. The way oracles operate is it doesn't post data every block. So oracles trigger data updates based on a percentage deviation, generally between the real world and what's already on chain. So if in the real world the price of Ethereum hits $3,500, an update might not necessarily be triggered at that point, but theoretically the position could be liquidated. So rather than waiting for the price of Ethereum to either fall further to hit a deviation-based update, or waiting for a time-based update to trigger, searchers are able to see that position. They know it can be liquidated. They know the real-world prices hit that point. And then they bid for the right to trigger an extra data feed update. As Luke mentioned, searchers will quite happily on Ethereum mainnet bid over 99% of what the incentive is. And from Moonwell's point of view, it's effectively wasting the incentive that they were planning on giving to the searcher if the searcher doesn't need most of it. So the searcher will bid probably a high percentage of what they expect to get. They get a transaction that they can have included in a block, which then triggers a data feed update. They bundle that in a multi-call with the liquidation transaction. Moonwell gets 80% of the winning bid. API3 gets 20%. This is higher than one of the other solutions. And we think it's a fair value in terms of what API3 is providing, in terms of the decentralized data, while maximizing the revenue to Moonwell. The benefit here is actually whenever you have highly volatile markets, you actually get many, many, many more data feed updates than you'd normally get with a standard push oracle. And push oracles are the type of oracle that lending protocols like Moonwell have been built expecting. So rather than pull oracles, which can trigger data feed updates manually all the time, push oracles are what keep data feeds updated within this set deviation. So we are the type of oracle that Moonwell expects, but we can provide much better data feeds and return a lot of the revenue to Moonwell from those extra updates. The proposal we have is focusing currently on the markets on Moonbeam. I switched it very not too long ago. I tried to do it before, but I was having problems editing on the forum, so apologies there. The Moonbeam markets are quite small compared to Optimism and compared to Base, and we provide data to Moonbeam. So we're able to provide all of the markets with the data feeds that they need. Our data feeds are directly portable, or you can swap easily from chain to our data feeds. We've had the process to do that audited, and we support a lot of the compound V2 forks like Moonwell is. We have markets like Mendy, like Orbit, where they're the same code base, and we've been providing data to them for a long time. All of our data feeds are Oracle extractable value enabled. So we've actually had Oracle extractable value feeds live for 6 months with no problems at all. So we're as battle tested as you can get for OEV, because there aren't many other solutions that have been live for as long as we have. And at one point, I think we had something like 97% of the liquidations on one lending protocol were caused by OEV being triggered by searchers. So it's very successful. We expect it to return a large amount of revenue, and we try to keep the proposal as good a fit for Moonwell as we can and limiting the risks. Now, this isn't, although this call is just about OEV, I think actually API3 has more to give Moonwell than just OEV. We're a proven push oracle that supports 40-something different chains, and there's a lot of conversation in the Moonwell community channels about expanding to new chains. And certainly Moonwell have done very well coming originally from Moonbeam and deploying to Base, and the Optimism deployment's attracting a lot of TVL very quickly. API3 support, I think, every superchain and most of the launching ones currently as well. If we can prove that API3 can be a reliable partner and return OEV on Moonbeam, then whenever Moonwell are looking to deploy somewhere and Chainlink aren't going to be there or can't be there, API3 will probably be there, and we would like the chance to prove that we're not only reliable and safe, but we can provide huge value to Moonwell through this Moonbeam deployment. So, that's everything I have to say.
Thank you, Dave. Yeah, if anyone in the audience has questions, feel free to raise your hand or to leave a comment. And yeah, I encourage everyone to go check out that forum post that API3 posted.
I just have one more thing as well quickly, because I should have mentioned it. The other thing, obviously, Moonwell's a compound V2 fork. We actually have feeds live now for Compound on one of the networks they support. They've looked into our data feeds, the risk partners there, and they've approved API3 to be used there. So as well as having many existing lending markets using us, we're about to have some of the larger ones too. So.
Perfect. All right. Yeah. Thanks again, Dave. And from there, we will turn it over to RedStone. I believe we have Kuba.
Yes, I'm here. Thank you for having me. And let me tell you a bit about RedStone and our vision for OEV on Moonwell. Let me start maybe with a quick intro on RedStone. So in 2024, RedStone was the fastest growing oracle, getting from something around 200 millions to protecting a few billions of dollars right now. our main focus is on technology because I'm the software engineer, but still a CEO and founder of RedStone. And we also focus on innovation. So the things like LSTs, RedStone was the first one to actually start working with the liquid stake protocols. And right now we are expanding in the BTC-Fi, which is important in case Moonwell would like to add new class of assets to the protocol. Also, we work with amazing partners like Pendle, Morpho, Venus, Fractalent, Etina, Puffer, EtherFi, etc. And what's most important for the Moonwell community, we went through the official due diligence process with Compound. So we've been screened by Gauntlet, and the output, which is visible on the Compound forum, was very positive. So they recommend to use RedStone together with other Oracle providers. But let me focus right now on Moonwell and the OEV in general. So I wanted to have a broader vision, not to keep it only about RedStone. What could be the challenges and risk involved in connecting to OEV solution? So for me, the worst case scenario is creating bad debt. And that's the nightmare for all of the lending protocols. Basically, bad debt is a situation when the value of collateral drops below the value of a loan. Basically, the protocol Moonwell is under the water, and all of the stakeholders will need to repay the debt. So it's a loss for the whole community, but also a very bad impact on the protocol image. And the cause of bad debt is mostly lack of frequent price updates. So let's imagine the price of Ether drops for, I don't know, $2,600 as it was on the 5th of August to $2,200. So it's like a very sudden drop in a matter of a few minutes. And then the value of collateral is below the value of loans. Basically, the protocol becomes insolvent. And in all of this discussion, there are arguments that the update, because of OEV, could be delayed by, I don't know, a few seconds or up to 30 seconds. But we need to be careful with these numbers, because 30 seconds in the crypto world, it is a lot. So on that case, 3 months ago, on the 5th of August, actually during the 30 seconds, the price of the most liquid asset, Ether, dropped by more than 5%. And I hope some people in the audience can remember the case of Black Thursday, when the price of Ethereum dropped by 50%, causing the Maker protocol to become insolvent. So any delay is potentially super risky. And also what is important to focus on is the correlation between the delay and the network congestion. Because usually it's a spiral of that. When the market becomes volatile, there are a lot of transactions because arbiters would like to capitalize on the moving prices. Network becomes congested. Any delay that a protocol may experience in that moment is very risky. I would say it's like much more severe than the standard delay when there isn't so much activity on the protocol. So our approach when designing OEV was to focus on reducing the delay. With RedStone, is limited to 500 milliseconds because we use the off-chain auction mechanism that was built by Fastlane, one of the leaders in the OEV extraction. And with the competing solution, it goes up to 30 seconds. I would say the second largest risk for any OEV solution is the most common threat for all of the protocols in the DeFi space, which is basically being hacked. And we need to be careful with introducing any changes to the code. So an example of that could be a recent hack on the Compound protocol, when Compound introduced a new mechanism for distributing rewards. So basically something that you may say it's not risky at all. It's like a change of a secondary mechanism, and it costs 160 million to be stolen from the protocol because of a very tiny mistake. On the sanitization of arguments, they basically just check a condition when the value was larger instead of checking whether it was larger or equal. So a single character costed the protocol more than $100 million. And while we were designing the OEV solution with RedStone, on our end, it doesn't require to change any single line of code. Basically, we just change an address of an oracle. It's fully Chainlink compatible, and that's all what's needed to work correctly. Also, what is important for OEV is the dependencies for external system. So the question if the protocol works correctly if the OEV module experience like any downtime on any interruptions. It may happen, but we need to make sure that the worst case scenario, the OEV is lost, not the continuity of price delivery. And that's a very good question if all of these solutions will work correctly if the network is congested. For example, if a solution that is based on the gas price, will that behave correctly? And also if the solution depends on, let's say, like a secondary chain or network, that's also super risky. So in our implementation with Fastlane, we perform crash tests on the live deployments that capture OEV, and we deliberately turned off the connection to the auctioneer, and despite that, everything worked as expected. So the worst thing that could happen with RedStone is losing the OEV, but never delaying the price updates. Also, what is important with this decision is to make sure that whatever the community decides to do is future-proof, because any change, any update to the protocol is a lot of work. It's a screening process, it's a governance process, etc. And I'm just wondering if you still remember something that was called the gas token. It was very popular in 2020 during the DeFi summer. It was proposed by the 1inch protocol. It was called Chi gas token. And basically it was using one feature of the EVM that you can get a gas rebate. But soon the core developers of the protocol realized that some other builders are abusing the mechanism of gas rebate, make an improvement to the protocol, and the whole market disappeared. So what is important is to find a solution that is battle tested and that will stay with us. So being open, I'm really like the idea of MEV tax. I think it's a brilliant idea, very innovative. But my main concern is the fact that it's currently using the gas prices for ordering the MEV transaction. And if you are following the development of the base chain, a few days ago on the 1st December, Jesse Polak posted on Twitter a very powerful post that currently Base is experiencing a large congestion of transactions. And if every transaction is used basically to bid for the place in order to liquidate a position, that can be very dangerous for the Base network at all. Because every bid, even unsuccessful, will need to be put into block, will need to be sent to the Base chain. And basically, there are also limits for the scalability, not only for the base sequencer, but also for the blob space. So I would be cautious with overloading the features of the protocols and applying that for different purposes. Also, what will be important for all of the potential OEV solution is the market adoption. Because any new kind, any new type of solution, we require the solvers, the searchers to adapt to that interface and to update their trading bots. And we deliberately worked with Fastlane, which is one of the largest operators of solvers, probably the leading player on Polygon and many other networks. And the interface is already known and used by a wide group of solvers. And I think it's important to have some standardized API and be also compliant with solutions that are available on other chains. And maybe the last piece will be about RedStone, because in our solution, actually as a side effect of connecting to RedStone OEV is the possibility of bringing more price update on chain than in the current situation. It is because of the fact that whenever there is an opportunity to liquidate a position, solvers are incentivized to bring this price update on chain. So we do not need to wait until the price crosses the deviation threshold or until there is a heartbeat. As soon as there is a chance for liquidation, a solver can take that bid and bring it on chain. And we update the bids to the auctioneer model every few seconds. It depends on the asset. So for the most popular blue chip asset, we can even go below a second. So that will be the expected latency under which a price could be brought on chain by a solver bot. I think that's all I wanted to share, and if there are any questions, happy to take them.
Thank you, Kuba. Go ahead and read up on RedStone's forum posts and leave feedback, comparing the different proposals. And the final voice today that we have in the OEV debate is Elliot from Solidity Labs. If you're here, you can unmute, and the floor is yours.
Thank you all for that. It's great to see all these different solutions and get have a forum for the community to discuss paths forward and how we should implement this. So I'm Elliot. I'm the founder of Solidity Labs. We're a boutique consulting firm focused on smart contract development. For the past year and a half, we've been contributing to the Moonwell protocol. We help with the go live on base, and we've have a proven track record. We've upgraded the governance system, so it's now multi-chain. So there's token holders on 3 chains that can participate in governance. We created the XWell token, which is an XERC20 token that allows Well to be natively multi-chain. And now we are proposing an OEV system that can help the Moonwell protocol internalize revenue that is normally given to searchers. So if you look at competitors on mainnet, we don't even need to name names, but they leave hundreds of millions of dollars on the table every year in terms of liquidations, because whenever an oracle posts a price update, then this leads to extractable value that the MEV bots can capitalize on. And basically, because of some unique properties of how layer 2s work and how base and optimism work in the superchain, we're able to create a system that allows the Moonwell protocol to internalize a majority of this revenue. Currently, there's a liquidation bonus, and that bonus, let's just say it's 7%, as an example here. Of that, a certain percentage is going to get given to the Moonwell protocol as reserves. And so this is the protocol C share. And right now this is at 3%. So let's say, if there's 7% liquidation bonus plus a 3% protocol, 3% protocol fee, then that means that there's like a total of 10%, let's just say in this example, that's paid on a liquidation. And right now the protocol is only getting, a third of the fees, or a little bit under a third. And I think with an OEV system, this would allow the protocol to capture a lot more. And as a previous speaker pointed out, you have to actually get these MEV relayers to understand the interface and adapt their systems such that they can make a profit from it. And so this is something where, as a part of implementing this, we're going to go ahead and talk to Flashbots and other relays and tell them about this change in interface, and provide documentation so that they're able to use this system and perform liquidations. And the system that we're proposing, we have written 109 lines of code, and the contract is not upgradable. It is immutable. It has a lot of fallback and safety mechanisms. So right now, the initial proposal was for a 30-second period where OEV bot operators can provide this new price and then essentially pay the OEV tax. Now, this is a configurable parameter. So if we get a risk recommendation from Gauntlet that says, hey, we think that it would be safer to have a 10-second period or a 15-second period or a 5-second period, this is all configurable in the smart contracts. And after that 30 seconds is up, the new price update will post automatically. Currently, the Moonwell protocol, for all of its price feeds, we use Chainlink. So we would not be adding a new dependency there. We would just be using what we always have been using. And we're also, the system is going to be fully audited. So currently the contracts that we are proposing are under audit by Halborn. And with such a small code size and such a small contract size, I'm hoping that they're not going to be any findings there. And the proposed rollout plan would be to go live on Optimism first, and then on the ETH market, and then slowly scale up over time. And I think this could be a really great opportunity for the Moonwell protocol to essentially give less to MEVers that are very value extractive, or they provide a useful service, but it allows us to internalize that revenue. And so I think this is really exciting, and I'm open for any questions. Just some things that I wanted to point out just around like the safety of this 30-second delay. So like I said earlier, that is a configurable parameter, so that can be changed to a lower number, and it can be moved around based on how the markets are. And really the question you have to ask there is, how fast are markets moving? Is there going to be a single tick that in 30 seconds is going to be such a drastic move on large caps that it would precipitate bad debt, which I would think would not be the case. We're open to hearing other opinions and getting Chainlink's feedback or getting Gauntlet's feedback or other risk managers and hearing what the data says on that. And with regards to, there was a few things that were kind of thrown out about, Black Thursday, where there were these liquidations and some borrowers on MakerDAO protocol got the short end of the stick. So that actually, what happened there, that was actually a smart contract bug. So it actually wasn't an issue with how fast the price moved, but the issue there was that Maker basically just let you bid for zero to seize collateral. And so that was kind of the issue there. And so I don't foresee economic risks in that sense with only a 30-second possible delay. Now, we think that the delay will get, in cases where there are liquidations, we think that the delay will not be used and that MEVers will just pay the tax to proceed with the liquidation. And yeah, we also plan on setting the system to all the searches and flashbots. And this is, as lindy as possible. It does not introduce any new price fees, and it's what the community is already used to. I think that is all from my side, and I am open for questions.
Thank you, Elliot. Yeah, any questions, you can put them in the chat.
Sorry, Alex, just quickly, I was wondering if I could say a little piece about the delay, because obviously Cooper's mentioned that. Cooper and Elliot, I love the simplicity of your solution, I have to say. I see you have a similar delay. It's parameterizable. That's great. API 3 has had OEV feeds live for 6 months. We've not seen any issues with it. The searchers that are waiting for these big liquidations, they want the volatility. When the market's doing nothing, they're not triggering any liquidations. So we actually tend to see more updates when the market's volatile. Our solution isn't focused around only bidding on existing data feed updates that are planned to happen. Searchers trigger extra updates. So instead of seeing bad debt when the market moves rapidly, you'll actually see more data feed updates. So users get a better result and the market should be less likely to have bad debt. That's what I wanted to say, really. And unlike, it's not something that's theoretical. We've been live for a long time with OEV and we've not seen any problems with this at all.
Awesome. Thank you, Dave. Yeah, if there's any responses, feel free. Or if you want to reply to any of the comments in the chat.
Well said, Dave. Yeah, I did want to just jump in here with some data points. I don't want to really express an opinion yet because I really want to thank all three contributing teams for the proposals, and I want to let the community decide. But I did want to share some data points from my own research on Chainlink based on Ethereum mainnet, which has been around for years, of course, and has seen a lot of volatility through Black Thursday and other trying market times, and also on Base, which has only been around for just over a year. But has also seen a pretty healthy market liquidation event on August 4th that we talked about earlier. So I looked at the Chainlink documentation and I confirmed some of these numbers with the Chainlink team. Basically, Chainlink has been around for 6 years and it's very lindy. Lindy just meaning in the technology term, like things that have been around for a while and haven't failed yet are less likely to fail in the future. But here's the data on Chainlink. So on mainnet Ethereum, Chainlink will post a price feed if the deviation of Ethereum, that's their main asset, right? Their most important collateral asset. If ETH deviates by 1% or more, they will post a price feed. And so in practice, what that means is that whenever ETH is very volatile, all of the MEV searchers that we've been talking about, these bots, they basically start to bid really heavily right before that 1% price feed lands. And so that means that they're actually looking at central exchanges like Binance and Coinbase, Kraken and others, and they're looking for, hey, what are the central exchange prices at? When's the 1% deviation going to trigger a price feed update? And let's bid for that, right? Because there'll be a lot of big liquidations around that, 1% price drop, for example. On Base, it's very different. The deviation is 0.15% or 15 basis points. So you're looking at a 15 basis points deviation versus 100 basis points on mainnet. And I think that's just because, I don't know exactly why Chainlink set it up this way, but I think that's just because Base has faster block times, it's cheaper to post, less gas, and it can be expensive to post during volatile market times because gas prices spike on Ethereum mainnet. So that means that in general, Base tends to be a safer network to lend your borrowable assets on, right? If you're a lender that people are borrowing against ETH. So the reason why I mentioned this is because even despite all of those market volatility back in Black Thursday and market volatility we've seen even in recent years, like with staked ETH depegging and even USDC depegged to 93 cents last year, the biggest lending protocols on mainnet have not incurred significant bad debt. In fact, they've been able to clear loans and liquidations very safely, and I think it's a testament to just DeFi in general of how efficient this has worked when all the CeFi lenders kind of blew up in the summer of 22, right? All the CeFi lenders like BlockFi, Celsius, and others blew up, but actually the DeFi lenders like Aves and Compounds of the world were safe. So I just want to mention those data points of the standard deviation. Dave, I think API 3 is actually really interesting because it can post the price even before it hits like that 1% or 15 basis points deviation if there's a price that people want to post, which is cool. But I just wanted to mention that. And then another thing I wanted to mention is that because Chainlink has a node operator network that consists of something like 27 different node operators, they have to kind of coordinate and filter any outliers. That means that every price update that Chainlink posts is probably going to take about 30 seconds to a minute just to kind of coordinate off-chain with all the different node operators, make sure that the data feeds all agree on the same price before they post it. And so that's something that Chainlink has been really good at because they have so many node operators. I mean, I guess it would be really interesting to hear from both RedStone and API 3 about your data sources and kind of how you do the off-chain coalescing of the central exchange data sources and the decentralized exchange. I'd be curious to learn more about both of those solutions. So let me pause there. I know that was a lot to unpack, but I just wanted to share some data on the Chainlink feeds that we've been using so far and also that have been pretty lindy on mainnet, I would say.
Yeah, if I can jump in. So thank you, Luke. Yeah, totally agree with your points. And I would say it's always a very tough question whether 30 seconds is a long period of time. If not, whether DeFi is safe. So let me maybe start with some facts, because I'm in the crypto space in 2016. I've seen a lot. And for example, one of our largest customer right now is Venus platform. And 2 years ago, they acquired bad debt when the Luna Terra crashed. And it was 20 millions. And basically, it was like very devastating for the protocol itself. And honestly, no one in the hindsight could predict that. It was a very sudden price movement. As far as I remember, there was like connected to Chainlink oracles, but basically like the price was dropping so fast that I don't know if like any other oracle could serve us. We believe that we can build the faster price update, but the market was under extreme conditions. I believe that we should be prepared for like this kind of a black swan event, because if and when the market is stable, it's quite easy to implement any solution, but we need to be prepared for this very, very rare occasion, like 0.001% probability, because that's when people can get lost, can lose money. Referring to your question, Luke, about the sources, RedStone currently is connected to almost 100 different sources. So we query the price from the off-chain centralized exchanges directly, reducing the latency, but we can also query that from the on-chain dexes. We get a very interesting methodology that is based on the on-chain slippage, so we can detect the price movement much faster. And we are also connected to the enterprise level data providers like Kaiko, etc. So we mix everything and we try to focus on the quality there.
Thanks, Kuba. So, Luke, in response to your points, firstly, I want to address something Kuba's just said. He mentioned the depeg caused by Luna. That was actually not caused by the rapidity of the movement. That was caused by Chainlink oracles having hard-coded a 10-cent minimum price for Luna. I think that was what caused the Venus depeg, specifically a faster pricing update wouldn't necessarily have done anything there. But on to Luke's point about data sources. So API 3 is what's called a first-party oracle. Kuba mentions data sources. I'm not sure if there's any way to actually verify those sources are being used, and it's not necessarily clear how it gets from source to chain. API 3 works directly with providers that provide big Web2 enterprise-grade clients with pricing data. We have them attest to running our oracle. They post the address of the oracle that they operate in their domain or in their DNS data. So you can verify that, yes, this address is indeed operated by this data provider. And then on-chain, so all of our aggregation happens on-chain. You can see exactly what each provider is trying to post, verify that it's coming from their oracle address, and we have a graphical user interface for this all on API 3 market. So if you see an aggregated on-chain price, you can go back and see exactly how that's made up of. You can look at the data providers, verify they are running on Oracle, and it's all completely transparent. So we don't have this kind of trust you approach. We want people to know where the pricing data is coming from. Chainlink have a lot of nodes, but again, I don't want to fudge Chainlink too much. Chainlink nodes are, you have to trust that they're calling different data providers, whereas with us, you can verify that it's indeed different pricing providers. We have the ability to provide DEX data. We have the ability to provide centralized exchange data through these providers. And yeah, like I said, it's all completely transparent. When you go on the blockchain, when you're interacting with a smart contract, when you're depositing in a lending market, you can go on BaseScan, you can go on EtherScan, you can see exactly what everyone's done. It's all transparent. You can trace it, you can verify, you can look at the code of what you're interacting with. And the core of blockchain is don't trust, verify. And we take that approach to the data as well, which is something we don't see many other Oracle projects doing. So yeah, I think long-term for Moonwell, we can provide like a trusted source of verifiably decentralized price data, and also give you guys some pretty good OEV cuts, and also support you in new networks. Thanks.
All right, thanks, Dave. Yeah, if anybody wants to get in their like final rebuttals here, feel free. Andrew or Sai, if you're here, you can raise your hand. I think there was a bit of a time crunch. Gauntlet might not be able to make it on as planned. And if that's the case, I'll just point everyone to go ahead and look at their latest monthly risk recommendations. So I think that'll be it then for the call today. If nobody else has any other points that they want to bring up, thank you again for all the speakers. This was a very engaging. This is actually, I think, the most in-depth call I think we've had so far. So I encourage everyone to go look at those forum posts and to probably listen back to this recording so you can all digest the info a little bit better. And yeah, happy holidays, everyone celebrating. Thank you again, and we'll see you all in January. All right, thanks, guys. Cheers.